Mercantile Exchange. Barry also holds a doctorate in hypnotherapy and is a certified NLP practitioner, which allows him to help people with the psychology of trading. He has been featured in several publications on his insights into technical analysis and is a regular contributor at Trader Kingdom. And with that, please welcome Dr. Barry Burns to the Trading Pub and his presentation today on simple tips to dramatically improve your trading discipline, remove fear and hesitation, and trade with confidence and consistency. And with that, Barry, the floor is now yours.
Well, thank you, Raleigh. I appreciate that. And all the good people over at Trading Pub, thank you very much for the nice introduction and for the invitation to participate in this really amazing event. Wow, what a lineup. This is just incredible. I remember in the days of yore, we would have to actually get on a plane and pay for hotel bills and meals and transportation and all that stuff to go hear expert traders from around the country and around the world. And you guys have put together just an amazing lineup here today where from the comforts of our homes and offices, we're able to do that. And thank you so much for organizing this. And I'm very pleased and privileged to be heading things off here today and be the first speaker. So I am, and by the way, welcome to everybody who is attending this morning. And we got a good crowd and people still piling in, so that's great. Let's get started. Now, Raleigh already did a nice introduction for me there, but I'll give a couple of little updates since then. Wiley Publishers came and asked me if I would do a book as part of their Dummies series of books, which you probably heard about, very famous series of books on all different types of topics. And so just finished Trend Trading for Dummies, and I'm the author of that, and it just came out about 4 or 5, maybe 6 months now. I keep saying 3 months and then 4 months and 5 months, but every month keeps going on. So anyway, great book. Put a lot of my energy and time and experience into that. I've been trading well for about 4 decades now, so a lot went into that book. Received Reader's Choice Awards pretty much every year from Stocks and Commodities Magazine. I've participated in investing in derivatives, featured there. Work with Ninja Trader, the CME Group, eSignal, Metastock, Eurex Exchange, providing education and training for all of these different organizations as well as others. And so been around the block quite a few times. All right, let's do a very important disclosure here. We've got to get our, the people who matter to us the most. Our warm, kind, dear, sweet, lovely, salt-of-the-earth lawyers. We want to make sure they're happy because, gosh, there's nothing more important than making our lawyers happy. So, but actually, even though I tease about that, this really is very, very, very important. Not only legally, but also this is really where your education begins. Because these legal disclaimers came out of some pretty bad experiences that some people have had, called losing money. And so the government and regulatory agencies have put together some things they like us to say in order to help other people from having those same bad experiences. So I'm going to just spend maybe a little more time than some people do on this because this may be the most important thing you hear all day. Because this is a reality. This is the no BS stuff. This is to give you realistic expectations of what trading is really like without any hype or anything like that. And by the way, just want to tell you too, as far as my part of the presentation goes at least, I've got nothing to sell to you today. So you can put your wallets away. I'm not selling anything. I do have some free gifts for you at the end. So I'm giving away some stuff, but I'm just here to give you pure education today. You can't buy anything from me if you wanted to, so I got nothing to sell you. All right, so first of all, let's go through this because it is so important. Trading is not suitable for all people. Hey, no profession is, right? And so why would trading be suitable for everybody? It's not. Some markets are leveraged, and therefore it's possible to lose more than the amount of money deposited for a position. Very important you talk to your broker. They're the ones who know your account, what markets you're trading, what kind of margin and leverage is made available to you, and ask them, what is your maximum risk exposure? A person should only use funds they can afford to lose. That means don't trade with money that you need for your home payment, your car payment, your kids' college education, or your retirement. Only trade with discretionary money. Losses do occur in trading, and therefore only trade with money you can afford to lose. All information in this presentation is for educational purposes only. I'm not going to be giving any buy or sell specific advice today. The use of the information in this presentation is entirely at your risk and for general purposes only. And we assume no responsibility or liability for errors or omissions. All right? So there you go. I spent a little more time on that than some people do, but again, I really do consider that the beginning of trading education to be realistic and come in with your eyes wide open. Trading is a profession, and like any other profession, it takes education, and to take that education seriously, to study hard, it takes time. It takes getting some experience under your belt. It's not a get-rich-quick game. And so please take it very seriously. Okay, so let's jump right into our main topic now. What moves the markets? What really moves the markets? You know, it's so easy as screen traders, people who trade from our computers, to think that all these lines and wiggles and indicators and jiggles and dots and arrows and all the stuff we put on our charts are actually what moves the market. And that is not the case at all. I lived in Chicago for a little while, had an apartment there, had a mentor, actually turned out to be several mentors. And so I've been on the floor of the futures exchange there at the CME. That was before the merger. And when you're there, you really get a feel for what really moves the market. So let's talk about that a little bit here. First of all, my dad, as Raleigh mentioned, he was a trader and he was a stock trader. So I started learning to trade stocks by my dad when I was 8. And my dad used fundamentals a lot. He was more of a fundamental guy. Now, he did some technical analysis too. He used price patterns, he used volume, he used a couple moving averages. But he was much more into the fundamental analysis. And so I learned a lot of that. But now I am primarily a technical analyst. So the reason for that is, you know, do fundamentals matter? Well, yeah, they do. Of course they do. They're important. However, the problem is, over the years, we've found that, hey, some of these companies actually cook their books. And then beyond that, sometimes the numbers are revised. The numbers they give us were not right in the first place, innocently. And they just, you know, found out new information and then they revise them later. And then some of it's just the way the market goes. The market can go up on good news and down on bad news. Well, that's what we would expect. But then sometimes the market actually goes up on bad news and down on good news. And so it becomes very unpredictable. The market doesn't always do what it's supposed to do, what it so-called should do, what would seem logical. And part of that is Dow theory of discounting the market. What that means is that traders don't necessarily trade what is, they trade what they think is going to happen. You know, we used to call trading speculating back in the day. And I still kind of like that term, even though that's a very old-fashioned term. Kind of prefer it because it keeps in front of our mind that trading is risky and we are speculating. And so when we talk about the Dow theory of discounting the market, that coincides with the slogan that people tend to buy the rumor and sell the news. And that is exactly why sometimes the market will go up on bad news and down on good news because the play was already done. And by the time the news comes out and things are confirmed, the trade's over. The trade's over. So then the pros are getting out. They're done with it. And they're moving on to the next speculation. So what really moves the market is the people. The people. Now, today when I say the people, I'm also talking about computer programmers because in the stock market, for example, over half of the shares traded every day are done by computers. So that has made a big, huge difference in the way that things move, that markets move. And so we have to update our trading methodology to accommodate that. And but it still comes down to people, even the programmers, because it's based on their thoughts and their feelings and beliefs about the markets. So, and they program that into their trading logarithms. So the market moves based on people's beliefs and their feelings, but it's lots of people. So when we talk about the markets moving based on people's actions, we're talking about mass psychology. Not one individual, not a few people, but lots of people. The markets are basically huge auction places. And so the markets move based on the principles of mass psychology. And by the way, the principles of mass psychology are different than the principles of individual psychology. Different rules apply. So I'm a technical analyst because I see technical analysis as the mathematics of mass psychology. So I'm interested in what the masses are doing. What's not what the market should do based on some report, but what people are actually doing based on whatever information comes out. Where the buying is, where the selling is, where the energy of the market is, and the energy refers to the flow of money, the buying and the selling. I'm not interested in what people say, but what they do. As we know, actions speak louder than words, and that is extremely true when it comes to the markets. I want to see people's actions, not even the bids and the asks. I don't care about bids and asks. I care about actual buys and sells commitment of money. So that's what makes the market move, the bottom line. And when we talk about putting together a trading method and so forth, we need to base it on that. So what's the nature of the market? Well, the movement of the market is the movement of mass psychology. So the nature of the market is actually human nature. And charts are maps of collective human behavior. The market isn't like people, it actually is people. And nothing gets plotted on a chart until people take action. So charts don't map people's only their thoughts, beliefs, hopes, and fears. Charts map their commitments. And again, that's what I'm interested in. I'm interested in people's actual buying and selling. And this is why I use technical analysis, because it tells me what are people doing right now. And that's why I base my trading about that. So my trading is based on that, and the nature of the market is human nature. Well, what is human nature? What's the nature of people? Well, we're goal-oriented, so that refers to trends. You know, we're born and our whole life is determined by goals. So when we're babies, we have a goal of learning to walk and to be able to feed ourselves. It's called basic survival. And then after that, we learn to read and to socialize and to grow and to learn. Children are learning machines by nature. And that's because they have a goal of growing up and learning. And then getting a profession. And then finding a spouse and having children. I mean, these are typical things, not obviously required. Some people choose to do certain of them, some don't. But all of our lives are determined by, goals. We're on a linear path here. So it's built in our nature to have goals. People are goal-oriented by nature. And so our whole life is one big trend. Now, in that trend of our lifespan, things don't always go smoothly. In fact, they quite often do not go smoothly. And so in our lives, we have oscillations as we move toward our various goals. And we even have a famous saying that we talk about: 3 steps forward, 2 steps back. That's how life is. And that's right. And that's how the markets are too, right? They don't go straight up. They don't go straight down. They kind of wiggle up and they wiggle down. They have oscillations. Sometimes in life, we get stuck. And we get stuck on our trends. We don't continue through. Things slow down. And sometimes it seems like our path to our goal even comes to a complete stop. and that in the market's reflected by consolidation. And then people live in cycles. I mean, even the fact that our heart beats, we breathe, inhale, exhale is a cycle of respiration in human beings. We work during the day and then we sleep at night. That's a cycle. We work hard during the week and then we take weekends off. That's another cycle. Human beings are by nature secular. However, those cycles are not always regular. And so, therefore, sometimes we work really hard, like when I was in graduate school working on my master's, my doctorate, before a paper or an exam, I'd pull all-nighters and work all night. And then after that, I would crash and take time off. So in market theory, we talk about cycles as expanding and contracting. You can't just put a certain number of days on a chart and measure every 9 days, which is kind of a common number, and think that the market's going to reach a cycle high or a cycle low every 9 days. It's not that regular. It's not that perfect. Cycles expand and they contract. Sometimes they're long and sometimes they're short. And of course that adds complication, but we need to incorporate that into our market trading. And human beings, traders, are emotional beings. We love, we hate, we overreact, we get passive aggressive. And we're definitely not always logical. In fact, all the psychological studies on this have shown that people primarily make decisions based on emotion and then justify them with logic. And so we need to see that that's going to be in the markets as well. The markets are not going to be logical all the time. And so we assume, quite often when we do computer programming, things like this, to create market systems, even the word system assumes some sort of logic to it. To program it, you have to use some sort of logic. Problem is, human beings primarily make decisions based on emotion and not logic. And so it becomes very, very challenging. Now, so that's the market. We were talking about the big auction plays, mass psychology. Now let's bring it down to individual psychology. What about you? What about you as a trader, your psychology when you interact with the markets? Well, as I already stated at the beginning, most people lose money trading. So you've got Plato's principle at work here, which is the 80-20 rule, more commonly known as that. Roughly 20% of the people make roughly 80% of the money. The good news is each one of us think that we're going to be different than the masses. In other words, we're not going to be one of the 80%. Every single one of us think we're going to be part of the 20%. Otherwise, we wouldn't trade, right? Now, the bad news is everyone thinks they're different from the masses. And therefore, wait a minute, you're thinking exactly like the masses because you think you're different than the masses, and everybody thinks they're different from the masses. Therefore, you are actually thinking exactly like the masses. Okay, a little brain twister there for you early in the morning. I know I don't mean to make your brain hurt here, but that is what the Chinese call an iron circle. And sometimes that's misinterpreted as circular reasoning, but that's not really what it is. An iron circle in Chinese philosophy refers to a way of thinking really more along the lines of what we would call a paradigm that is a faulty paradigm, but we get stuck in it. And the only way to get out of it is you can't logic your way out of it. You can't think your way out of it. You need to transcend it. You need to actually change the paradigm. So it's kind of hard to do that because, again, we wouldn't even trade unless we thought we were part of the 20%. And yet everyone thinks that, and therefore we think like everybody. Okay, so how do we get out of that? How do we get out of that? How do we transcend that? This is an exercise, a very practical exercise now that I'm going to share with you that has helped me and others transcend that. So I want to invite you to consider doing this. Up to you whether you want to do it or not. It takes a little bit of work, but hey, trading is a profession and not a get-rich-quick scheme, so it is going to take work if you're going to be successful. So here's what I did to break myself from the mentality of the masses. So I got into a lot of different free live trading chat rooms. All right, again, this will be a great exercise if you choose to do it. This can change your trading forever. Now, the key is you want to choose trading chat rooms that are very active, where the traders are talking to each other, but we're not interested in the chat rooms where you actually have a professional trader in there who knows what he's talking about. Okay, now those are good, obviously, for learning from a professional trader, but for this exercise, that's not what we're interested in. In fact, we want exactly the opposite. We want a chat room where all of the retailers are, a bunch of people who really, frankly, don't know what they're doing, okay? And that's why they're usually free chat rooms. Now, watch what people are saying and listen to them over and over, day after day, week after week, month after month. Yes, this will I did this for about 6 months because what we're looking for are patterns. And so you need to do this over a period of time to see those repetitive patterns in the retailer's mindset. And by the way, when I talk about a retailer, I'm talking about generally people who are losing money. Now, what you want to do is when they're commenting on the market, saying, oh, I'm going to do this, I'm looking at this, and whatever, look at the charts they're looking at in conjunction with their comments. So you're putting together their comments with what's going on the chart. Remember, the masses are wrong most of the time. So what you're hearing is the inner dialogue and behavior of the losers. You do this for 3 to 6 months, listen to their comments, watch the chart in conjunction with their comments, and before long, you'll be able to do the reverse. Watch the charts and then hear the dialogue of the loser. So let me give you a quick example here. There were several of these patterns that I noticed people doing over and over and over and over and always getting wrong. All right, so here's one, just to give you a specific example. So let's say it was an E-mini trading room. Okay, so people would be watching this and the market would be going up and up and up and up. And inevitably, somebody would start posting saying, oh my gosh, this market is just going crazy. This is way overbought. There's no way it can go any higher. I'm shorting here. And they'd go short. They'd get filled. Market would go down just enough to fill their order. And then, guess what? The market would turn right back up and make a higher high. And then that person in the chat room would say, oh, god darn it, dag nabbit, or something to that effect. And they say, I just got stopped out. I can't believe it. I can't believe it. This market is way overbought. There's no way it can go any higher. Okay, well, you know what? Now it's just crazy. I mean, it's impossible for it to go any higher. I'm shorting again. This time it's going to work. And they might even give some other reasons, blah, 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 fill in the blank. Didn't matter what the reasons were. Fact is, we're watching their behavior and looking for the kind of things that people do over and over. And so they would short and they would get filled and then they'd get stopped out again and the market would make another higher high. And then, of course, the expletives would fly. It's like, God damn it, I can't believe it. What's going on here? This is ridiculous. And they would usually try one more time. They'd usually try at least 3 times, sometimes 4 or 5. And every time get stopped out and the market would continue to go higher. One of my mentors used to call this kamikaze trading. And because it's a suicide mission, you're trading against the overall direction of the market, the overall energy, the dominant direction of the market. And usually the last comment they would say then, and I've heard this a million times, if I've heard it once, they would say, well, the market's just unreasonable today. It's just crazy. This makes no sense. I'm going to play golf. And usually that's what they would say. I'm going to play golf. I'm going to go play some tennis or something like that, and they would leave. Now, I have watched people do that at least 100 times. That same pattern. That is a very common trading pattern of retailers. Trading against the trend, in extended trends, in overbought conditions, and continually piling loser upon loser upon loser. Now, so there's several of these patterns that I've been able to see. That's one of them that repeats all of the time. And again, I would listen to the comments, and then I'd look at the chart they were trading. Now, after doing that for 6 months, I actually, again, it's that repetition, that massive repetition that's key. You start to get it imprinted into your brain cells because you hear it so much, and you look at the chart and you see what they're doing over and over and over, that after a while, you actually start to be able to do the opposite. In other words, now I can look at a chart, and just in my mind, I can hear what those retailers were saying in the chat rooms with this chart pattern. I'm like, oh, I know what they're saying in that chat room right now. And that's great, because guess what? The retailers are usually wrong. And I see that. And so that is what has allowed me to transcend the mentality of the masses. And in fact, actually do the opposite of them. So it's kind of a programming thing that you do to yourself, a mental reprogramming to get outside of those thought patterns. Because for some reason, trading is, actually there's a very logical reason for it, but trading is deceptively difficult. Trading, I even wrote an article about this that said, good trading is unnatural. And it is. It's unnatural. Our natural instincts do not help us with trading. In fact, just the opposite. And there, again, don't have time to go into the reasons for that now, but there are very good reasons for that. And so this type of exercise to learn to transcend your natural thoughts is very important in order to become a profitable trader. Okay, so let's move on. Great book, famous book, Market Wizards. Jack Schwager interviewed some of the most successful traders in the world, and what he was doing was he was looking for a commonality that led to their success. And so he interviewed all these people, and then the book, actually there's a series of these books now, highly recommend them, by the way. So he interviews them, and there's a lot of different things people say, a lot of different ways people trade. But again, he was looking for that common thread. And at the end of the book, here's his conclusion after all these interviews. What set these traders apart? Most people think that winning in the markets has something to do with finding the secret formula. The truth is that any common denominator among the traders who are interviewed had more to do with attitude than approach. So in other words, yes, technical analysis is important, having a trading method, rules, all that, very important. But that's not what set aside the great traders from the not so great traders. Had more to do with their own mental development than it had to do with their trading techniques. In his follow-up book, The New Market Wizards, he wrote this. When asked what was important to success, the market wizards never talked about indicators or techniques, but rather about such things as discipline, emotional control, patience, and mental attitude toward losing. The message is clear. The key to winning in the markets is internal, not external. Absolutely true. You'll never read a truer thing in your life. So it's obvious to be a successful trader, you need a viable trading method with setups, rules, a plan that works, of course. Without that, no amount of psychology is going to help you. So that comes first. Unfortunately, there's many traders who have a viable trading method and they never know it. Why? Because they never tested the method divorced from their emotions. So for this reason, personally, I recommend, and good traders differ on this, but my personal opinion is it's very important to paper trade any method. Now when I say paper trade, it's better to do it with a demo account or a simulator where you're actually entering trades into an execution platform, but just not using real money. Okay, and do that for at least 3 to 6 months. And I know for some people that's like, oh my gosh, really? 3 to 6 months? No, I want to start making money next week. Well, you're not going to. So if you're brand new, and if you do make money next week, that's probably the worst thing that could happen to you as a new trader, because you got lucky and it's going to make you overconfident, and that's like the worst thing that can happen. So to be realistic, use a demo account, use a simulator, and trade one method. The other problem that people have is jumping from one method to another, to another, to another every other week. And so they never learn any one real method and get it as part of their instincts. So you do that for a long time, and obviously, once you start, if you do, start making money, fake money, consistently, then move over to trading a very small amount of real money. But you've got to test a methodology without the emotion, or at least, and that's not even possible as a human being, but with as least emotion involved as possible, because that's what I'm saying. A lot of people think they've tried all these different trading methods and none of them work. Usually there's many, listen, I got so many friends in the trading world, it's crazy. And they're all trading different ways. So there's many ways to groom a cat here, and a lot of them work. There's a lot of viable trading methods that are very different from each other. But the problem that most retailers have isn't the trading method. You might have one right now that actually can work and would work for somebody who has the discipline, the focus, and the consistency to trade it perfectly. It comes down to self-management. Now, this gives us the additional benefits of helping you learn the timing of the entries. Okay, learning to enter your orders without hesitation is critical trading behavior for your success. And it also, see again, now some trading methodologies may be viable, but they're not right for your personality. I've got friends who, I know exactly how they trade. I know their methods, but I can't make money with it. They make money with it. I can't make money with theirs. Why? It just doesn't fit my personality. I'm not comfortable with that. So that's another aspect of it. What fits your personal risk profile, what makes sense to your brain cells, all these kind of things. We're each different in that way. So by paper trading for 3 to 6 months, keeping track of every trade, using a trading log, literally writing it down, you'll find that, which methods work and which don't, as long as you treat it without emotions. So you got to have confidence in your method. Without confidence in your method, you'll be second guessing the rules, get discouraged, get drawdowns, which are natural, but then those are going to affect you too much. So the only thing that creates confidence in trading is success. And the best way to achieve a winning track record is to trade without emotion, or with as little emotion. And that means trading without money to get started. Okay, so let's move on here. This is one of my biggest problems that I had, overtrading. It's one of the biggest challenges of many new traders. But one of the hallmarks of successful traders is they actually trade a lot less than you probably think. So, and this is what I've learned, and this is what helped me become successful, was actually waiting for what I call fewer, better trades. And this is what professionals do. We wait for perfect setups, because we know the only time that the odds are really with them and make a difference between trading and gambling. Gambling is where basically you go into a casino and you trade the slot machines. You know those slot machines are programmed where the odds are against you and they favor the house. Well, trading is not gambling if you do it right, because if you have a viable trading methodology, it's actually created with a positive expectancy for you. But those margins can be very slim. That edge, just as with the casino, sometimes those edges are kind of slim. And so you can't really, even if you've got an edge, you've got to trade very disciplined. You've got to wait for the best of the best setups. Don't take ones. In fact, one of my rules in my trading approach is very rule-based, very objective, very black and white. But one of my rules is, if I'm not perfectly clear on this setup, then the answer is no. It's not a setup. I always default to no, unless it's perfectly clear. So I'm always taking what I call fewer, better trades. Now, in the gambling world, the best scenario in the gambling world is poker, because you're playing against other people. So in the gambling world, there's people who actually make consistent money, and I've met some of them. I don't play poker myself much, but I'm not a professional poker player, but I know some people who are. And it's interesting because they fold on more hands than they play. If they don't have a strong opening hand with a high probability of winning from the very beginning, from the first deal, they simply fold and they wait for a better one. And that's analogous to what we're talking about here, where we will only trade if we have a perfect setup, and that means passing on most setups. Now, the challenge there sometimes is that setup that you passed on, which wasn't quite perfect, will take off. And it's so easy to mentally say, oh man, I should have taken that. No, you should not have. Just because the market followed through in the direction you thought it was going to go does not mean you should have taken it. That was not an opportunity lost because the opportunity wasn't there. What the market does is of no consequence if it didn't meet your criteria, which is based on a positive expectancy. Wait for those good ones. Now, in trading, in fact, we got it better than the poker players because they got to ante up on all these hands that they're folding. We don't have to ante up. So it just is a matter of being very patient. Now, one of my favorite books in the world for trading is this book right here. Highly recommend this book. And this is one of my favorite trading books in the world, and it's not even about trading. It's a guy named John Patrick, and he wrote a book called Money Management for Gamblers. And trading, of course, involves a lot of money management. So again, in Chicago, what I found was these guys on the floors, what they were doing was trading. Their methods were very simple. Their techniques were very simple. Where they really shined was in their money management, their risk management, and their personal discipline, ironclad discipline. That's what made them different than retailers. And by the way, that goes along with what Jack Schwager said in the book that we referenced earlier. But anyway, here's John. Now, John Patrick is a very colorful character, so we're going to have some colorful words here. I hope you don't mind that. But he is definitely a realist. And this applies to trading so well. It's just crazy. Again, this is a no BS zone here today. I'm not selling you anything. I got nothing to sell, and I'm just laying it out there like it is. Real trading, profitable trading is very different than what most people think it is. So as I said, number one, professional traders trade a lot less than most people think they do. Number two, here's another one. And I'm just going to quote from the book as he says it so much better than I could. People who are way better educated than me rip my theories from here to Hades and back. They claim gambling is all math and statistical analysis. They will never grasp the true meaning of gambling because they have never been there. People who think that a math equation is going to give them a leg up on winning ought to have that leg whack them in the area where they sit on their brains. Okay, so as I said, he's kind of a colorful character. But again, how analogous is that to trading, where people think it's all about math and statistical analysis? And again, here's a guy, and some poker players, they do base their games on that. Some traders base their game on that. And there's a place for that, but that's not going to be all, because why? Back to where we started from at the beginning of the webinar. The markets aren't logical. Why? Because the people trading them aren't logical. So he says, and this is this next paragraph, wow, this changed my life. The pros don't make mistakes. Now the capitalization there is my editorial. And they don't have tells. Patience is a virtue. Definitely applies to trading. Stupidity is a one-way street to disaster. Talk is minimal and mercy is absent. Absolutely true. Anybody who's been down to the CME on the floor, yeah, it's not a place of great mercy. It's not church. Make a mistake and 7 vultures circle the wagons, waiting to divide the spoils. When the night is done and you're fortunate enough to escape with a small profit, the ride home gives you only a short time to count your blessings and your money. Oh my gosh, is that true? Again, you're exploiting a small edge. If you can get a small profit every day, right? We're not hitting home runs every hour on the hour. That's just not the way it is. then you've got to have that perfect discipline, no mistakes, patient, wait, take the perfect trade, take fewer better trades. That's exactly what he's saying. So if you're not trading well with the successful methodology, it's most likely because you're making mistakes. So is there a way to eliminate mistakes? Answer is literally no. There's no way to eliminate mistakes. Answer is literally no. There's no way to eliminate mistakes. Nobody ever becomes a perfect trader. But the first step to reducing your mistakes, to minimize them, is to identify them. So I've created a list of what I call my 10 commandments, which are general rules. And we're going to translate those into specific mistakes as they would relate to the rules of our trading methodology. So when I talk about eliminating mistakes, I've created a list of specific mistakes, 10 of them. Now, let's see, we're not going to have a lot of time to spend on each one of these. If you would like a list of these, I'll be happy to send it to you. Just send me an email at barry@topdogtrading.com. And I will send you this written list so you don't have to sit here and, rate your fingers down to the bone. Okay, Barry, B-A-R-R-Y, @topdogtrading.com. And I'll send you, or I'll have my people send you a list of these 10 commandments. But let's go through them real quick here. So number 1, thou shalt not chase a move. If you ever find yourself, you've missed the ultimate entry point, and you didn't get in right then, don't get in. Don't chase the market. One of the biggest mistakes people make. Number 2, don't trade in choppy markets. Trading, by the way, is not a zero-sum game. Every trade you take, you start with a loss. Why? Slippage, commission, fees, all that kind of stuff. That's kind of your ante-up right there. So you got to really have a good edge because you got to get out of a hole on every single trade. Without a clear directional movement on your side, you don't have an edge, and without an edge, you will not have a profit. Okay, one way to avoid that. Here's a little technical tip. Never trade when the 50-period simple moving average is flat. Whenever this 50-period simple moving average is flat, I don't trade. I just stay out of that. I'll look for a different market. And boy, one of my mentors taught me that, and he said that saved his life. Let me tell you, he taught me that like 15 years ago. And it's saved me so much money. It's crazy. It's not one of those rules that makes you money, but sometimes the rules that save you the money are actually the ones that leave you with the winners and reduce your losses. Here's another one. Thou shalt not trade kamikazes. This is what I was talking about before, where people continually short higher highs, higher highs, higher highs. This whole thing of market being overbought or oversold. I don't know. There's something in the human brain that wants to do that. I mean, I know I have that urge to do that myself, and a lot of traders do. It's very common. It's kind of built into the human psyche. It is death. It is death. Never trade that way. You will blow out your account. Number 4, don't trade too many contracts for your account size or shares or lots or whatever you're trading. If you lose more money than you're comfortable with, then you're going to start trading badly. Then emotion's going to take over. So in other words, you want to keep your losses very, very, very small. Even the best traders go through periods of days, weeks, and even sometimes months of losses. So you got to keep your losses per trade very small. Your losses per day very small. This is part of your money management. In my course, when I teach people, we provide them with a money management program where you have a maximum loss you'll take per trade, which is a very small percentage of your account. For me, it's 1/2 of 1% of my account. That's the maximum I will risk on any one given trade. And then I have a maximum, when I'm day trading, a maximum risk or loss I'll take on a day. And if I reach that dollar amount in a day that I've lost that much money, I'm done. I'm done. And what is that amount of money? Well, frankly, it's based on 2 things. Number 1 is mathematics, in the sense that it's a very small percentage of my account, so that and that actually leads to number 2, the psychological part of it, so that I never get into an emotional place where I get depressed or anxious or fearful where I'm like, oh my gosh, I lost so much money today. I'm freaking out. I'd be afraid to tell my wife. No, if you're getting to that emotional place, you need to change the threshold of your money management. Number 5, never trade just for the action. Business, or trading's a business, not an extreme sport. Number 6, guard your capital. It's your lifeblood. Without it, you can't trade. Number 7, never try to recover losses. It's called revenge trading. It's an emotional way of trading. Number 8, don't worry about missing the boat. Your goal is not to catch every move in the market. That's, again, another mindset that it just seems natural that most people have this mindset that they're supposed to catch every move in the market. And if they don't, they feel bad and they try to reverse engineer it. Oh, how could I have caught this? And it's like they're constantly changing their trading method based on how they could catch every move in the market. Here's a clue. You can't. You never will. So instead of doing that, what we do is we call what's called making the market come to you. We have our method. We know it has probability that favors us, and we just wait for those setups. The market can do all kinds of other stuff. It can make big, huge moves without us. We don't care. Just because it made a big move does not mean that there was a high probability setup for us to take that move. And if there's no high probability setup, then we have no business taking it, because the next time we'll take a loss on it. The next 10 times we'll take a loss on it. Thou shalt not worry about missing the boat. Number 9, thou shalt not place your stops too close. Now, if you are doing this, it's an excellent indication that you're not in the right time or the right frame of mind for trading. So you shouldn't be trading right now. You can't trade scared, in other words. It's an issue of fear. Stops, where are stops placed? There's a logical place to put your stops. Stops go where you're wrong. When the pattern you're trading is broken. And when that's broken, you should be out. Don't wait for the market to come back. If the pattern's broken, the reason for your trade is violated, you're done, you're out. That's why I place hard stops. Okay, but you got to give the market some room to wiggle, because markets are like people. They're wiggly. They're imperfect. They're not linear. There's a little bit of chaos and randomness to the market, and you have to allow for that. And finally, thou shalt not take profits too soon. So it's nearly impossible to make money based on win-loss ratio alone. Why? Because, again, we've got costs in there, hard fixed costs. Scalping is really for pros. Mostly floor traders, they can do a lot of scalping, but they can play a different game than screen traders can. So your monies could be made by having a respectable win-loss ratio, yes. You can even, I've got friends who, their win-loss ratio, they only win like 33% of the time. And yeah, so they lose 60% of the time, but they still make money. They still are profitable. Trend traders typically have a win-loss ratio less than 50%. Breakout traders often have a win-loss ratio less than 50%. So how do they make money? Well, then the only way to make money is to have your winners be a lot bigger than your losers. So be patient with the trends. Let them ring up the big money for you. And don't, sometimes people see that P&L turn green and, oh my gosh, I'm up $100. They get excited. They want to lock that $100 in. No, you can't do that. Again, that's emotional trading. So one of my favorite sayings goes along with what Pat said there. Successful trading is simply a matter of not making mistakes. I found this to be a great truism in my own trading life. As long as I don't make mistakes, I come out ahead at the end of the week or the end of the month. The mistakes I refer to are, again, those 10 commandments, and you might come up with some more. That's just my list. I encourage you to add to the list and make it your own. Make your own list, but that's the springboard for creating your own list. Some of those problems you might have, others you may not have. Again, we're all a little different as to which things we struggle for. The goal, the bottom line here, is to trade the method as strictly as possible without making those mistakes, because avoiding mistakes is a matter of self-discipline. And by definition, I can't give you self-discipline. But what I can give you is an exercise to help you tremendously to acquire and to develop self-discipline. but you have to stick to it. So I'm going to give you another exercise now. This is the second exercise today. Again, very, very practical exercise. This works, but if you work it, again, it's not one of those things that is going to just help you in an hour or a couple of days. This is, again, a thing that you have to practice over time, repetitively. But if you do it, I promise you, you will be glad you did. This is the kind of thing that turns losing traders into winning traders. All right, so here it is. So this is my trading log. And, all trading courses say, oh, yeah, you should have a trading log and all that. And that's fine, and you should. But mine's a little different than most. So here it is. And by the way, again, if you'd like a copy of this, I'll be happy to send it to you for free. Just send me an email at barry@topdogtrading.com. And we'll send out this form for you. Okay. So, but let me explain how this works. So we got our trading log. You put the date on there. You notice that at the top I put successful trading is simply a business of not making mistakes. This is what separates the pros who make money from the educated amateur. Why do I call them educated amateurs? Because they've read a lot of books, they've taken a lot of seminars, and they're still losing money. Okay. So what they're not getting is this. And what is this? Well, here we go. Okay, so on the left column there, you'll see entry time, trading vehicle, what market you're trading, your entry price, your protective stop, first and second targets. Again, you can adapt this if you want to, if you take 3 targets, 4 targets for profits. And then when you get out and the price you get out, your gain, your loss, and your total gain loss. Okay. So that's cool, that's fine. We're just recording our entries and our exits, where we got in, where we got out, and at what price. Frankly, your broker can give you that information. So what we want to do is we want to do more than just that. So underneath that, you'll see in the gray area there, the gray rectangle, it says notes. Now, in notes, what I actually put there is what I was thinking during the trade, especially when I first entered, and number 2, what I was feeling when I took the trade. All right, and as the trade progressed, and when I got out. So I'm monitoring my thoughts and my feelings during the trade. It's kind of a little biofeedback mechanism. And what you're going to do is you're going to, that's just for one trade. So you can put 3 trades on each piece of paper, as you can see here. And over time, you'll be reading this, and you're going to review these at the end of each week, and you're going to start to see patterns of your own thoughts and feelings as you took trades. And then you'll associate those thoughts and feelings with the winning trades and the losing trades. And you'll start to see, gosh, you know what? When I get losers, I'm always thinking this, or I quite often feel that. And that's going to, again, you can reverse engineer that, just like we did with the chat room. But now you're doing it with yourself. Now you're doing it in your own brain. And you're going to start, it could even be the same example. You could be saying, well, okay, I'm shorting this because the market looks really, 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 really overbought. This was the other one, the other phrase. So they often use the same phrases even. One of the phrases they always used in those chat rooms was, the market looks toppy here. Yeah. Oh, if I heard that phrase once, I've heard it a billion times. The market looks toppy here. It's just funny how people say even the same things. They use the same language over and over and over, and it just never gets through to them. And so you might put that, you might see that you put that down. Oh, the market looks toppy, I'm going short. And then the next day, another one. The market looks toppy, I'm going short. Loser. Next day, market looks toppy, I'm going short. Next day, the bottom looks, bottomy, I'm going long. Looks oversold, I'm going long. And you'll start to see patterns there, so that whenever you start thinking that in the future, then it'll register to you, wait a minute, whenever I think this, I always get a losing trade. Okay. Very, very, very important. Big tip, big tip. Okay, so that's what we do in the notes. What you're thinking and what you're feeling. Am I feeling afraid? Am I feeling hesitant? Am I feeling nervous? Am I feeling excited? Am I feeling euphoric? Am I like, oh, I know this is a winner? I mean, that's another one. That's when I actually had that one quite a bit where I'd say, well, this one, I know this is going to work. And usually they wouldn't. It's like, wow, how come I know it's going to be, I feel so confident, and they never work when I feel that confident. I've got a friend, he's a professional trader, and I studied under one guy who said you always need a positive expectancy. That was his big thing. He always would talk about positive expectancy. And then I learned under this other guy, and whenever he took a trade, and we traded together literally in the same room, and he would always say before he took a trade, yeah, this isn't going to work. And so his thought process was the exact opposite of the other guy. And I said to him even, I said, every trade you take, you say, yeah, this isn't going to work, but then you still take it. What in the heck? I said, this other guy, I won't mention his name because he's actually a pretty famous trader, but this other guy I learned from, he would always say you have to have a positive expectancy. It seems like you always have a negative expectancy. Why would you take a trade? And he said, again, he had done kind of a similar exercise to this, where this was his game. This was his mind game that he played with himself, and it worked for him, where he just felt that if he had to monitor his emotions where he wouldn't get too excited about any given trade. Because he knew if he did, that led him to a mental place that gave him too much confidence, and if the trade, broke a stop or whatever, he'd pull the stop before it got hit because he got too positive about it. And so he just found for him, and again, it's different for each person. This is why you have to do this exercise for yourself. I can't give you this information. You got to give this information to yourself because we all think and feel differently. But he found that by just always saying, oh, this trade's probably not going to work, he became more conservative in his trading, and his risk management was better, and that worked for him. Well, God bless him. He's making money, can't argue with that. Different for each person. Now, in the next rectangle there, the yellow one, that's where you record your mistakes. Now, we go back to the 10 Commandments, right? Those mistakes, or maybe some others. And so if you take a losing trade, or you know what, even if you have a winning trade, if you made a mistake, you put it there. So again, what's a mistake? Well, the market set up good and it hit my entry point, but I didn't get in right away. I hesitated, and then I took the entry too late. Why is that a mistake? Because now your risk is screwed up. Your risk-reward ratio is messed up because your risk is bigger than it should have been because you didn't get in on time, and so now you're chasing the market. Or another mistake would be, well, I put my stop in, but then the market turned against me, and I didn't want to get stopped out, so I pulled my stop. And then the market kept going farther and farther and farther, and I ended up having a huge loss. Or another mistake would be, didn't let your winners run. I took my profit too soon. This would have been a huge winner. I could have made $5,000, but I only made $200 because I got too excited about, a green 200 on my screen. Whatever, okay? Or this was not a perfect setup, but I felt good about it. It looked good. That's another one. Oh, that's another phrase that I hear all the time from people. Well, it's not a perfect setup according to my rules, but it looks good. What the heck does it looks good mean? No, that's you can't trade looks good. And yet a lot of people do that, and that's exactly the phrase that they will use. Put it in there, write it down, and again, now, over the next days, weeks, months, you continually go back to these trading logs, and you start to see your patterns. Your patterns may be different than my patterns. And you'll start to see, oh, maybe you put down, a lot of times where you said, well, didn't meet my trading rules exactly. It was close, but it looked good. And you'll see, gosh, 9 times out of 10, when it looked good, it was a loss. So whenever I'm thinking it looks good, better not take it. Or I take my profits too soon. 1, 2, 3, 4, 5 times I did that. Oh my gosh. We underestimate how many mistakes we make. We generally have a sense in the back of our mind of our common mistakes, but believe you me, when you put it down on paper in writing and then you review it, you're going to see that you make those mistakes a lot more than you think you do, and it's going to shock you. So what we do is, to make it even easier, we take that daily trading log. Okay, now that previous trading log, that's where you record every trade. And this is basically for day traders, but you can do this as swing traders too, obviously. So, but using the day trader example, so maybe you take whatever, 3 trades a day, 5 trades a day, 10 trades a day. Okay, then you transfer that day's worth of trading, all those trades per day, over to this weekly trading log. Now, this weekly trading log has 5 rows. Okay, you see the 3 gray ones and the 2 white ones. And so we're going to summarize the trading for the day onto each of these rows. So for Monday, I would start with that top gray row, put the date, number of winning trades I had, number of losing trades I had, the total profit, the total loss, the average dollar amount won per trade, and the average dollar amount lost per trade. Now, you do this every day, as you can see, 5 days down there, and then at the bottom row, total, or the week's totals. And then at the end of a month, you'll have 4 of these sheets. And you're going to find out what your real win-loss ratio is and what your real risk-reward is, your average win, your average loss. These are going to be your real numbers. People always ask, well, what's the win-loss ratio? You know, it's different for each person because of people's behaviors and how well they trade, how disciplined they are, and so forth. Now, this is going to be the number that matters, your win-loss ratio, your risk-reward ratio. And then you're going to take that and you're going to start working on it to try to improve your win-loss ratio and improve your risk-reward ratio. How do you do that? Well, we keep going. Then we add commissions to it in the next column. That's actually, we subtract that. Your net P&L after commissions, and then the percentage of your account that you won or lost that day. Next column, number of mistakes you made. The next column, the net P&L you would have had, profit and loss. What would be your net profit and loss if you didn't make any mistakes that day? So now you'll go back to your trading log, the daily trading log, and you'll subtract all the money of all the trades where you made mistakes. And what are you left over with? So if you did not make those mistakes that day, what would have been your profit or your loss without those trades where you made mistakes? Okay, and then in the final column where it says mistakes, you're actually going to list the individual mistakes. Now, if on a day you had, let's say you took profits too soon on 3 trades, well, you don't need to write it in 3 times. You just write in took profits too soon, and then the number 3 to know you did it 3 times. But it's very important there that you actually list what the mistakes are, define them there, and then how many times you made them that day. So you do this day after day after day after day, every single day, but now you've got a summary sheet. So it's all on one sheet for a week. You get about 4 of these, and at the end of the month, you're going to see the patterns. This is where the magic happens. Now you will see your patterns. 2 things happen here. First of all, again, it'll be an eye-opener. This paper is actually a mirror into your trading psychology. And you will see, oh my gosh, I mean, I knew that I took profits too soon, but I didn't realize last month I did it 30 times. Wow, I had no idea I did it that much, and that's what's going to happen. You will find out you do these same things over and over and over, way more than you think you do. Then here's the magic. Is going to that column right before that, the net profit and loss without mistakes. And I've done this with traders. I've done this with a lot of traders, in fact, face-to-face in my office where I've done personal mentoring, and I take them through this exercise. And I would say about 80% of the time, when we go to this column, net profit and loss without mistakes, they find out that if they would just stop making mistakes, they're already a profitable trader. It's crazy. And here they are searching for more mentors, more trading techniques, more indicators. They didn't need any of that. All they had to do was stop making the mistakes, and they're already profitable. When they see that number and they say, oh my gosh, I'm already a profitable trader if I just stop making mistakes, That is life-changing. That is a light bulb going on, and it's exciting. And that is what provides the motivation to stop making the mistakes. That is what creates that inspiration and gives them the power to stop making the mistakes. So that is my presentation for today. Here's my information. Again, feel free to write me and ask me for any of those forms, Barry at topdogtrading.com. Today also I am giving away one of my courses for free. This is my free 5-day video correspondence course. What you're going to do is you're going to get 5 videos, and these 5 videos, each one lasts about 15, 20 minutes, something like that. And then at the end of each video, there is an interactive quiz. The theme of these videos is how professionals trade differently than amateurs. How professionals trade differently than amateurs. That's the overall theme. Also, on day 4, the 4th video, you're going to get one of my favorite trade setups called the rubber band trade. So you're actually going to get a trade setup with the rules, the filters, all of that stuff. It's a great trade. It's got a super high win-loss ratio, and absolutely my gift to you. And one other gift you're going to be getting is my personal cycle indicator. Now, that cycle indicator is an indicator I use for timing my entries and exits. I have found that one of the biggest challenges that people have, one of the biggest things they're missing in their trading is timing. You know, if you think about it, a chart is really just a two-dimensional object. There's price on the right axis and time on the bottom. And yet, very few traders have any kind of accurate timing tool. Most indicators are based on price. Well, if time is 50% of the chart, which it is, then how can you possibly create a probability scenario into your trading without incorporating time? I mean, you're leaving out 50% of the information on the chart, so you can't have a probability scenario. W.D. Gann actually said time is more important than price. So anyway, I'm giving you the gift also of my personal cycle indicator, which is actually a modification of a very standard indicator that's on all the charting platforms. So it's we modify that, and then I teach you how to trade that timing indicator so that you're finding the final cycle highs and the final cycle lows to trade. And it just dramatically reduces how much you get stopped out. That's going to be presented on a webinar next Tuesday, but by signing up for the correspondence course, you'll be given the link to the webinar. Again, it's a free webinar, and again, I'm giving away the cycle indicator and how to use it for free too, so not charging for that. So yeah, just go to, we got obviously a URL shortener there, bit.ly/tradingpuboffer. And I see they just posted that with a link, a clickable link in the chat box. And that's it. I think we've got about 5 minutes where I can take some questions. Is that okay? Can I use 5 minutes for questions, or do you need some time for the transition?
Yes, absolutely, Barry. We have 5 more minutes, and folks, this would be a great time, to go ahead and post some questions. I'm sure that you have some. I think Barry's done an excellent job presenting his material.
Okay, Bill
so
asked,
let's
do I
take
trade
this time
bonds?
here so
Yep,
that he can address specific questions that you might have.
Can you successfully do 20 trades a day? You can, but I would think that the only way you can do that successfully, operative word there, Han, is to trade very short-term time frames and also trade multiple markets. So Mark's asking if I like, and also trade multiple markets. So Mark's asking if I like to trade crude. Yeah, so the way to get more trades is exactly that. I'd like to trade crude. I like to trade gold, the E-minis, euro, currencies, bonds. So what I'm doing every day is I'm looking at a variety of, generally uncorrelated markets, because maybe the equities aren't really doing anything one day, but there's a great opportunity to go short crude or to go long the euro or whatever. So yeah, it's possible, but you've got to be trading short-term markets, and you've got to be or short-term time frames, and looking at a lot of different markets. Okay, Scott says, Barry, you have a Metastock plugin. Yes, I do. Can you say your best? Can you say your best trades there with explorations? Can I say? Well, yes. That's one of the great things about that plugin is you can search for the best trade setups. And yeah, I can do it with both daily and weekly charts. See, I use multiple time frames, and that's one of the great things about Metastock is that we can actually do the search for both of those time frames and only give us the candidates that line up with both time frames. And so yeah, it does. It's fantastic. What time is the best to trade each day? It varies by market, Bill. It depends on, now you're asking what time interval for the chart or what time of day to trade? Time of day to trade varies. I mean, the opens are usually pretty good, but as far as time intervals, it varies because of, I mean, I look at the volume of the market. That would dramatically change what my time interval would be. I like to use tick charts a lot. And on high volume markets, I'll even go down to a 2-minute chart sometimes. Okay, let's see. Whoops, it's starting to slide by here really fast. We've only got 2 minutes left and the screen's going fast. Okay, which market is the easiest to start with? I don't know if that's a tough one. There's no market that's the easiest to start with. There's no such thing as easy, but it's a good question, Peter. That's kind of a big question. It depends a lot on how much money you have, but if you don't have too much money, then you got to use leverage, but leverage is a two-edged sword, and I feel like then I need to make some legal disclaimers and so forth. Which market to trade? If you want to send me an email, I can answer that question with a little more detail about the considerations that you would have in determining which market you want to trade. Okay, I don't really like the word easiest. I'm a little uncomfortable with that word. Do you have software which finds the best trades for you? Yeah, there's various scanning programs that you can use. Depends on the markets that you're trading, stocks, forex, futures, whatever, and also what time intervals you're using. Again, if you want some recommendations on that, send me an email. Tell me what you're trading, and I'll send you some an email which answers that for the market and the time interval that you trade. Roland asks, which tick charts? Depends what market I'm trading. Again, you know, that has a lot to do with the volume in the market. E-minis, I like to trade the E-minis, and for that I use a 1,000 tick chart, a 3,000 tick chart, and a 9,000 tick chart. What's my second best setup on the new plugin? I like the first retrace and the trend trade. Scott, yeah, first retrace and the trend I like a lot. Setting a daily goal. Yeah, that's not a bad idea. That's not a bad idea. But you can't really do that until you find out what your average wins are over time. Then you kind of know the statistical norm. And yes, I know a lot of traders who will do that. They will set a daily goal, and once they reach that goal, they'll stop. And that is often a good thing. Yes, it is. Okay, well, I've got 18 seconds left, so that leaves me just enough time to say thank you to the good people at Trading Pub and to all of you who attended the webinar here today. Feel free to take advantage of this free offer and enjoy the rest of the speakers.
Well, thank you, Barry, for kicking off today's Trade-a-thon with that terrific presentation on how to build confidence and consistency in our trading activities. I really like how you shared those insights into the difference between successful traders and the mass of retail traders that are out there, and that attitude is apparently more important than approach. I also appreciated that little nugget on staying out of choppy markets, and when the 50 simple moving average is flat, I'm going to go ahead and take a look at that immediately, and your emphasis on the value of keeping consistent and accurate trading logs. I'll just share with you that I am a tennis player, and I play a lot of tennis, and it was a real revelation to me the one time that I had my wife actually chart my shots during a match, and I was amazed at how many unforced errors I had